For every Airbnb, Tesla, or Google that turns into a billion-dollar success, there are countless startups that fail, taking millions or even billions in VC money with them. Venture capital is high risk, high reward, and while investors hope to back the next unicorn, the reality is that most startups don't make it. Some fail due to market miscalculations, others due to bad leadership, overhyped technology, or reckless spending. These failures provide valuable lessons, both for startups and the investors who fund them. Let's take a look at some of the most infamous VC-backed failures and what went wrong. Few startup failures have been as spectacular as WeWork. Once valued at $47 billion, WeWork promised to revolutionize office spaces with flexible co-working hubs. But behind the glossy branding, WeWork was hemorrhaging cash, burning through billions in an unsustainable business model. CEO Adam Neumann's reckless leadership, extravagant spending, and lack of financial discipline became a red flag for investors. When WeWork attempted to go public in 2019, investors scrutinized its finances, and the company's valuation plummeted from $47 billion to less than $8 billion in weeks. The IPO was canceled, Neumann was ousted, and SoftBank, its biggest investor, had to rescue the company from total collapse. Hype doesn't equal success. Even with massive funding, a weak business model and poor leadership can destroy a company. Theranos, once valued at $9 billion, promised to revolutionize healthcare with technology that could run multiple lab tests from just a few drops of blood. It attracted huge VC investments from top firms like Draper Fisher Jurvetson and Walgreens, along with powerful board members, including former US Secretaries of State. But the problem? The technology never worked. Founder Elizabeth Holmes misled investors, regulators, and patients, faking test results and covering up failures. When investigative journalists exposed the truth, Theranos collapsed overnight, and Holmes was later convicted of fraud. Investors lost hundreds of millions, and the company became a cautionary tale of what happens when hype overrides due diligence. Due diligence is critical. Investors must verify technology claims and not rely solely on a charismatic founder's vision. Juicero became a symbol of Silicon Valley excess, raising $120 million from top VC firms like Kleiner Perkins to create a Wi-Fi-connected juicing machine that sold for $700. The company positioned itself as a game-changer in the food tech space, but when customers realized that they could simply squeeze the juice packs by hand without the machine, the business became a joke. Juicero shut down in 2017, and investors lost everything. Not every problem needs a tech solution. If a product doesn't offer real value, no amount of funding can save it. Quibi was a short-form video streaming platform backed by $1.75 billion in VC funding from firms like Sequoia Capital and Hollywood Studios. Its pitch? Premium, mobile-only streaming content in 10-minute episodes. But Quibi ignored changing user behavior. It launched at a time when people were already addicted to TikTok and YouTube, both of which offered free short-form content. Despite its huge war chest, Quibi failed to attract users, and within 6 months of launch, the company shut down completely, making it one of the biggest VC-funded failures in entertainment history. Understanding market demand is key. No matter how much money a startup raises, if users don't want the product, it will fail. Color was a startup that raised $41 million in funding before it even launched. Its pitch was to create a social network for sharing photos of clothes, where users could take pictures of outfits, get feedback, and interact with fashion brands. The problem? No one wanted it. The app had a confusing interface, failed to build a real user base, and quickly ran out of money. Despite pivoting multiple times, Color never found product-market fit and became one of the biggest VC-backed flops in history. No amount of funding can replace product-market fit. If customers don't need it, a startup won't survive. Pets.com became the poster child for the 2000 dot-com crash. The startup, which raised $300 million, aimed to revolutionize pet supply e-commerce, offering pet food and accessories with home delivery. But the company spent massively on advertising, including a Super Bowl commercial, without proving it could make a profit. As e-commerce logistics were still expensive at the time, Pets.com burned through cash too quickly. Less than 2 years after launch, it went bankrupt. A cautionary tale of overhyped startups with no clear path to profitability. Sustainable unit economics matters. Scaling too fast without profitability can kill a startup. These high-profile failures aren't just cautionary tales. They provide valuable lessons for startups, investors, and anyone in the venture capital ecosystem. There are several common patterns that consistently emerge when analyzing startup failures. Understanding these patterns can offer valuable lessons for both entrepreneurs and investors. One of the most frequent causes of failure is a lack of real market demand. Companies like Juicero, Color, and Quibi are prime examples of startups that launched products without truly validating whether enough customers wanted or needed them. Without strong market demand, even the best-funded startups struggle to survive. Reckless spending and poor financial management also play a major role in startup collapses. Cases like WeWork and Pets.com show how rapidly companies can falter when they burn through capital without maintaining financial discipline. Another common issue is overhyped technology that ultimately fails to deliver on its promises. Theranos became one of the most well-known examples of a company that captivated investors and the public, only to fall apart when its core technology did not perform as claimed. Failure to adapt to changing market trends has also led to the downfall of many once promising companies. Quibi, MySpace, and BlackBerry illustrate how rigid strategies and slow responses to evolving consumer behaviors can cause even strong brands to lose relevance and market share. Finally, overfunding before achieving product-market fit is a recurring theme in startup failures. Startups like Color, WeWork, and Juicero raised large sums of money early on, but without validating their business models first. This often leads to inflated valuations, operational inefficiencies, and eventual collapse when the market realities catch up. Recognizing these patterns helps illustrate how critical it is for startups to stay grounded, validate demand, manage resources carefully, and remain flexible as they grow. While VC firms accept that many of their investments will fail, the best investors learn from these mistakes and refine their approach, focusing on founders who execute well, markets that show real demand, and business models that can sustain long-term growth. For founders, these failures are a reminder that funding alone doesn't guarantee success. What matters most is execution, adaptability, and building something people actually need. Because in venture capital, it's not just about raising money, it's about proving you can turn that money into a lasting, impactful business.